Welcome to Life Goals Masterclass. I'm your host, Pallavi. Today's session will focus on ULIPs and we'll explore how and why ULIPs today are one of the best investment options, especially during the economic recovery post-pandemic. I'm joined by two of the big names in the industry, Mr. Sampath Reddy, Chief Investment Officer, Bajaj Allianz Life, and Mr. Feroz Aziz, Deputy CEO, Anand Bhati Wealth. I welcome both of you all to this session.
Thank you, Pallavi.
So let me begin with Mr. Reddy. First of all, tell us, do you believe that ULIPs or unit-linked insurance plans as a product are not really understood or clearly understood by most investors? Sometimes they're even confused with traditional endowment plans. What do you think?
Yes, I think to some extent what you're saying is true. I mean, ULIPs are relatively, I would say, complex as compared to other savings that are available in the form of debt and equity instruments. Especially in the unit-linked insurance plans, we are selling, savings along with the insurance, and even the insurance also. If you look at the cost of insurance, varies for a person to person, smoker to non-smoker, and also for the different age groups, the cost of insurance will be different. Overall, because of this, in the insurance product itself appears to be relatively more complex than the normal traditional plain vanilla savings instrument. That's one. And but over the years, I would say that insurance companies have taken many steps to simplify the product structure, and even the whatever the charges that are there in the various ULIP products has been simplified a lot. But still, I think having said that, it's a combination of savings plus insurance product. And also insurance, varies between person to person. Overall, the cost structure is slightly going to be different, and it will take, it is in that sense a little bit complex. Having said that, and when it comes to the traditional endowment plans, I think those things are completely different. I think investors do understand the difference between the traditional endowments and ULIPs. Yeah, vis-a-vis other savings alternatives that are available, ULIPs are somewhat, I think, difficult to understand, and they're a little bit product specific. It's not just the typically an investor in the equity market or a fixed income market, they just go by the funds and fund statistics alone. But here, when you look at the ULIPs, there is something like a product attached to it. There's nothing like a product you see in the the mutual fund space or any other savings avenues that are there. Here, you have to the product actually talks about various expenses that are charged, to the to the fund or to the customer. So one has to go through that in detail. All the details are there certainly in the product and the product illustration. But into the it takes a bit of time for people to understand and go through that. To that extent, yes, ULIPs are somewhat not very well understood by most of the investors, and rather it would take a little bit of a time for them to go through and understand the cost structure that are there in different ULIPs.
Sure. In fact, Feroz, I just want to take it from you now that as Mr. Reddy mentioned that it's not really understood clearly by investors. So according to you, how is ULIP as a concept perceived in India, and how do you look at them as a product which can really create wealth for long-term investors?
Pallavi, I think from a ULIP standpoint, like Mr. Sampath said, it is lesser understood because it's relatively more complex. Point one, I agree with that statement. Point two, I think it is in India bought from a taxation standpoint during the months of Jan, Feb, March, when you have to actually save the tax, which I think is not the right thing to do. Most people actually rush to buy it. So complex product with a rush to buy is a bad combination. So that's what I understand how it's happened this so far. But I think the industry is evolving. Cost structures are becoming more attractive. Any investment product will have its merits and demerits. If you can capitalize on the merit of the platform you're using for your savings, then it will be advantageous. For example, the tax advantage of the return, for example, on the ULIP side, in spite of this being capped in this budget to 2.5 lakh premium per annum, which is a reasonable amount, still exists. Switches are easy to do between equity and debt, and you don't get taxed. So point I'm trying to make is every platform will have its advantages. If you're not able to capitalize on those advantages, don't use that platform.
Okay, sure. In fact, Mr. Reddy, as we're talking about how ULIPs have evolved, I want you to make us and our viewers understand how ULIPs have evolved in terms of the cost, in terms of the returns, and in terms of the positioning also.
Right. Yes, I think in the initial years when the private life insurance industry, got opened up, during those times, the cost structures was quite, I think, relatively high as compared to any other savings in the industry. And after the 2010, the regulations have brought in, the maximum, the expense ratio that you can charge to the, funds over a period of, time. So that has basically, set the, tone for the overall reduction in the cost structure. And over the years, in fact, the industry, life insurance industry has moved ahead and, in fact, come out with products which are, I would say, as, cost effective as one of the best in the industry. Let's say even, you can compare some of the life insurance industry's cost structure similar to that of, or even better than some of the, the direct plans of, mutual fund industry. So we are on par with, pretty much one of the, lowest costs that are there for the investors to save in equity and fixed income markets. And to talk about, for instance, our own product, which is, the Goal Assure, where we are offering to the customers only the FMC charge of 1.35%. We're charging that's only 1.35% FMC, and also even returning the mortality charges to the customers. So which means the total expense ratio in the true sense, if you were to compare with the similar savings platforms that are there, is just going to be only about 1.35% plus of course taxes. Even the mortality charges which are being charged will be returned to the customers upon the maturity of the product. So you are actually getting the insurance cost free, and your savings are cost structure in terms of expense ratio on your savings side of the pool is pretty much on par with the direct plans of the mutual fund industry. So I think there's been a significant change in terms of the way that ULIPs have been there over the years.
Right. In fact, Feroz, we're discussing the different advantages and different features which ULIPs offer. And of course, we know that they offer insurance as well as investment portion. But according to you, is there anything unique you find in ULIPs which maybe we've not actually noticed or not really addressed so far?
Yes, I think like I mentioned as illustration, a couple of them, which is the tax efficiency at maturity for a 2.5 lakh, which is a big advantage. Apart from that, what I mentioned was a switch. See, when you switch between an equity mutual fund and a debt mutual fund, you have to pay the tax on the equity earning at that point in time. In insurance, for example, you've invested for 10 years. You've bought a 10-year ULIP, and you've accumulated, let's assume 100 rupees so far by paying your premiums. And you have 15 equity, 15 debt. If you want to move 25 from equity to debt, in a mutual fund, you get taxed then and there. In the ULIP, you can keep switching and not get taxed till the end, one. And there's no switching cost. In most ULIPs, they give a certain number of free switches. That's one thing which most ULIP holders currently also don't utilize. Not more than 1% of the people who have this amazing feature utilize. 99% never switch between equity and debt during the period of holding. That's my experience. Of course, the stats could be different. Second biggest advantage is more of the heart rather than the mind, to be more disciplined. See, most of us have this urge to spend money. So ULIP brings a certain degree of discipline. Flexibility is very good, but in financial products, too much of flexibility actually helps or compromises the goals which you have. Now, for example, if you've accumulated, let's assume 20 lakhs over the years for your child's education, the COVID situation might have just made you pull out 10 lakhs from it without being too worried, probably. So the discipline aspect which ULIP brings outweighs the flexibility given by the mutual fund. So that's one very important thing. Most people who have spendthrifts, a kind of a embargo that you can't use the money becomes a very useful tool.
Sure, sure. Of course, that's one point which needs to be looked at. So, Mr. Reddy, if I talk about the different features, and we are, of course, focusing on the dual feature that comes with ULIPs, the insurance and investments, could you tell us how this feature can really benefit the investors?
Obviously, the insurance brings in its own, advantage. A lot of people in India require, insurance, given that kind of income levels and given that, the dependency of the family and the breadwinner. So that brings the certain, clearly the benefit of insurance. And also, it is not very well understood the cost of insurance in the ULIP, to the customer, because at the time of at the beginning, in the first year when you pay the premium, the mortality charges appears relatively higher. But as you move ahead in terms of with your premium paying in second year and third year, overall the cost of insurance actually comes down. So the way as that, because the overall the market value of the fund itself, that along with your one is with the appreciation, other is with your contribution increasing, all of that taking together, the cost of insurance actually will keep coming down as you move ahead. So this particular aspect is not very well understood. Okay, they look at only the first year, the charges in terms of mortality, and it appears to be quite high. But as you move ahead, the cost of insurance actually comes down dramatically. 6-7 years down the line, there may not be any charges debited towards mortality, for a longer term, ULIP.
Okay.
So these things are not very well understood by the by the investors. I think that's
right. In fact, Firoz, just to add to what Mr. Reddy said, that the more time you give in, the cost will go down. So if you could tell us, like from a point of view of an investor, I mean, ideally, how many years should one put in when somebody is thinking of buying a ULIP or is already holding one?
Yes, I think 10 years is a reasonable time to let your savings grow. Okay, if you're speaking of emerged market, if you spoke to HNIs or even retail investors in the US, their definition of short term is 10 years, and long terms could be lifetime, right? But in India, you would find a person, I want to invest for the long term, and he'll come up with a 2-year kind of a time frame. And so that dichotomy, as we emerge as a more learned society from a finance perspective, those numbers will keep getting repegged at higher levels. But I think 10 years is a reasonable period. One thing which, from a cost standpoint, I think in ULIP, because there are so many schemes, it's a very cluttered space. The diversity in terms of the cost charge is so enormous that you have to be very careful. Okay, as a generic platform on a mutual fund, I can say these are the cost structures. This is the kind of limitations which are there regulatory. But I think in ULIPs and from a regulation standpoint, I think the cost structures have to be more narrow. It can't be so diverse. In some ULIPs, you will have a premium allocation charge, which is substantive, which is like money for jam from a commission agent's perspective or the insurance company. There could be some, like which was mentioned, which has 1.35% fund management, and the mortality is promised to be given back. Because of this dispersion, the buyer beware concept has to be right up there. Otherwise, you're going to be experiencing the worst of it.
Sure. So a lot needs to be understood about ULIPs. And since we are also talking about the other kind of products which are available, Mr. Reddy, I want you to help us understand how ULIPs fare compared to non-participating plans, especially when you're talking about the current economic recovery.
Yeah, non-participating funds are actually picked up a lot in terms of as a percentage of the new business that we are doing across the life insurance industry. Non-participating funds are actually the ones which are giving you the guaranteed investment, so that guaranteed return. So because of the volatility that that we had seen in the last financial year in terms of equity markets, volatility and significant sell-off during the times of COVID, I think since then the investors' appetite as towards the non-par products have improved tremendously, and life insurance industry is uniquely positioned today to offer the guaranteed returns of to some extent the current good interest rate environment, taking that into the queue, we can offer the better returns to the customers, which are prevailing today, even in the future premium that the customer is going to pay. So that's the normally if you go to any other savings product, whether it's a bank deposit or any other alternative fixed income savings platforms that are available, whatever is the interest rate today that is there, you will be able to save, invest at that rate which is available. But when you get the say when your savings pool increases in the next year, if you wanted to put that money also, you will be basically investing at that money depending on whatever is the interest rate then prevailing. If interest rates are going to come down over the period of time, you do not have an opportunity to save based your future incomes as well at the current somewhat closer to the current high interest environment. That's what is actually the non-par products are coming into the play. So even over if a customer is paying a premium over a period of 5 years or 10 years, even on those premiums which are going to come in the future years, his investment return is guaranteed. So to that extent, these products are picking up a lot in the life insurance industry today, and because life insurance industry can hedge these through some of the derivatives that are available in the market. We are able to offer this to the customers. So I think the non-par industry for the life insurance industry is doing very well.
Okay. Feroz, what is your opinion on the non-participating plan, especially in the current scenario where we're seeing the markets going up and we're seeing the interest rates falling down? What do you say?
So I think, like Mr. Sampath mentioned, that locking in interest rate is one. Locking in interest rates of your future savings is a separate thing altogether. So that's one. That's a very big advantage. Only flip side to it is I don't know how efficiently the interest rates are transmitted in a policy if I so chose to buy today. For example, before the budget, the interest rate, 10-year interest rate, or the GSEC as we call it, was at 5.8. Today it's at 6.25, which is a 40 paisa increase in the 10-year interest rates. Is that going to be transmitted? If that were to be the case, then I would definitely say a traditional plan can lock in the higher interest rate spike of the 0.4% for the next years for the current premium and for the subsequent premium. So it's a very good idea, but the problem is they don't get transmitted as efficiently to the consumer. So the timing aspect of it, I think today is very appropriate, but if you get schemes which can actually give you that 0.5% more before the budget and after the budget, then it's definitely a platform worth using.
Sure. So coming to the risk part of investment planning, Mr. Reddy, do ULIPs carry high risk as compared to the equity mutual funds? How do you explain us in terms of the risk factor involved?
Yeah, I think there are different funds which are in the ULIP. Like for example, typically any particular ULIP could normally be offering to the customers a large cap equity fund, or a mid cap equity fund, or a small cap equity fund, or a balanced fund, or a debt fund and a liquid fund, which is what we do offer. So obviously the risk factor for each of these underlying funds will be different for different funds. And largely I would think that the equity fund of a large cap equity fund typically would have risk profile similar to that of a large cap equity mutual fund, and mid cap equity fund of ULIP would have a similar risk profile that of the mid cap mutual fund, like so on and so forth. So I would not say that the risk profile is any different from that of mutual fund industry, especially when you compare it to fund level, mandate to mandate level.
Okay. Feroz, anything you want to add?
Yes, I think risk is a word which can be numerically measured, fortunately. And I think numbers suggest that on the risk parameter, they're not too different. For example, a large cap equity mutual fund has a 14 risk number, which is called the 14 standard. The standard deviation is 14. So if you compare it with a large cap portfolio created on the insurance platform, it would be close to that. So that's one. But the second thing, which when it comes to insurance actual portfolio performance, since they have so much time in hand, they're not scrutinized on a very consistent basis. Most ULIP owners or ULIP owners, of course, would not even know whether their respective portfolio has beaten the benchmark. And where does it fare across the several portfolio managers which are there in the industry? And the attention is on cost. And if you speak to an insurance agent, the first thing he speaks is cost. Right. Cost is value minus cost is what you take home. The focus is cost. Unless it becomes value, the industry will not actually capitalize on the value creation which it can do as a wealth generating platform. So I think that's where we are not, because of a closed-ended nature, there is certain degree of agility which is missing, which I think is something I'm sure will get addressed over years to come.
Sure, sure. Also talking about the asset allocation which comes with ULIPs, Mr. Reddy, tell us what portion do ULIPs, in general invest in the debts, and how does that help in building a long-term portfolio?
Yeah, so the asset allocation is not something handled at the fund level. It is largely handled by the investor himself by choosing different funds based on his risk appetite. As I mentioned, any particular ULIP would normally be having diversified investment products large cap equity, mid cap equity, small cap equity, the bond fund and liquid fund and balanced fund, etc. So underlying investor will choose his appropriate fund that is suitable for based on his risk appetite. For example, investors with relatively closer to the maturity may move some of their funds into the fixed income the fund, and in the most while staying invested in the equity funds for the long period of time in the initial period when he's saving with us. So these kind of asset allocation will be planned by the customer himself. And apart from that, as Feroz mentioned in his in some of his points, that the customers have the flexibility of choosing the different funds. They can switch between different funds any number of times, without having any taxation issue or without having any transactional cost issue while switching. So that with that tool available to the ULIP investors, they can plan their own asset allocation. If you think that markets are overvalued, you can move some of your money into the debt fund or a liquid fund. Or if you think that you've been saving with us for the last 10 years and remaining 5 years are left, and if you have made substantial amount of returns on your equity platform, you can move some of it to the fixed income side, giving that your remaining term for the with us is relatively smaller. So those kind of asset allocation decisions can be taken by the the customer itself. But as I said, we particularly offer different styles of savings so that the customer can choose the right allocation for itself.
Sure. In fact, Rose, you very rightly mentioned that when we talk of ULIPs, the only thing that comes to our mind is the cost. So I want to understand from you, in the last few years, if we look at charges which were associated with ULIPs, like policy administration charges and premium allocation, and there were some other charges also, which some of them are still there, some of them have been eliminated. But looking at ULIPs today, do you find them more attractive? And what is your overall view on ULIPs?
My overall view on ULIP is they have relatively become more attractive.
Okay.
But I think the guiding principles from a cost standpoint are very liberal.
Okay.
So each of these insurance companies are taking their business call of how attractive do they want to make it. Okay. Like mutual fund, for example, has gone through a huge transition to remove the bias of mis-selling. Anytime if the commission structures cost, actually the biggest thing about cost is cost defines commission structure. Commission structures defines the quality of advice. If there's a dispersion of commission 5 times between one policy and another, it is bound to create some degree of biased advice amongst agents and advisors. So I think that needs to be formulated better. So they have relatively become significantly better. If you spoke about 10, 15 years back, they were a complete no-no. They were only an advisor's product. I actually did a survey amongst all my advisors and found out how many people bought an ULIP for themselves, and not even one of them had actually bought it for their family. I think that is changing because the cost structure is becoming more transparent. But I think the onus has to be on the platform rather than the investor to be careful. I think that is what is desired, like I've already said. But I think relatively they're far, far better. They can at least be evaluated dispassionately by every advisor and every client today.
Sure. Mr. Reddy, since we are almost approaching the end of the session, I want you to summarize the biggest benefits which are offered by ULIPs as compared to other investment avenues. Some of it we've already addressed, but if you are to summarize it.
Yeah, ULIPs offer very good savings and investment vehicle for the investors, and the cost of insurance slightly, I would think, is misunderstood. As the customers stay for a long period of time, 10 years and 15 years and so on, the overall cost of insurance will be relatively small and negligible. There is a significant, I would say there's the switching benefit that insurance companies offer is also quite attractive to the customers. And moreover, the life insurance industry and ULIPs actually backed by a very good investment team, and they offer one of the attractive investment propositions that are available in the country, from an equity and fixed income platforms as such. So I would think the cost element earlier, which was misunderstood, is now earlier, which were high, is now brought down, and they do offer one of the best investment vehicles to the customers now.
Sure. In fact, Feroz, before we let you go, one very important aspect, which is the market volatility. I want you to make us and our viewers understand how does market volatility and performances of different sectors, they play on the returns aspect, which is ultimately delivered by the ULIPs.
Pallavi, I think market volatility in any instrument which does not take the full committed money at once is an advantage. It's not a disadvantage. I'm sure on the ULIPs, we have different frequencies of payment of premiums. If you want to take the advantage of market volatility, you can break your single per annum annual premium into larger frequencies. So market volatility is an advantage to an SIP, for example, on a mutual fund. A ULIP investment can actually take advantage of the market volatility, because whenever markets are down, you buy more units, and when the markets are higher, you buy lesser units. So it's an advantage. Now coming to what this volatility has in store, to my mind, the markets have always exhibited a yearly fall of 12 to 15% from the peak. So that's the attribute of the animal you're dealing with. So you can't be surprised, why has the market fallen 10%? I see quite a few people startled after having made an investment. That's an attribute which it has displayed year after year for the last 20 years. So you have to understand that market volatility is the price you pay to actually make twice more than the debt return. And as long as you hold on over 10 years, people have not lost money under any circumstance. So why be worried?
Sure. Last things last, anything that you want to advise to long-term investors, or maybe some factors, some key things that one should keep in mind when he or she is buying a ULIP? Feroz?
So I think what you should keep in mind is understanding each nuance is very important. I think this hands-off approach of an investor is not a good idea. Why? Because if you're going to use a platform for the next 10, 15, 20 years, maybe across generations, spending that time to understand is the key message I would like to leave people behind with. Second is, it's not just about cost. If you're evaluating a fund or an insurance company to actually delegate your ULIP fund management, check the fund manager, check the performance. Okay, cost is definitely going to be only 5% of the total value which you will end up creating. So the needle will move on the performance, not on the cost. That's the second piece of advice. And third, equity instruments are very, very important in a high inflationary economy like India. And a high interest rate economy like India. So equities have to form an integral part of one's core strategy, be it insurance or mutual fund for that matter.
Sure. Mr. Reddy, any last piece of advice for the investors?
I mean, so ULIPs are typically the longer term savings plan, with a minimum investment horizon of 5 years. And if the customers, do not, have that kind of a horizon, it is, I would think, it's not advisable. And especially, the customers who are saving for a really longer term, 5 years and 10 years and so on, the cost structure is very, very attractive. And, as Feroz was saying that, from a longer term perspective, equities do offer a very, very attractive proposition given the inflation that is going to be there in the economy. So, with that, you should have a longer term orientation to look at the ULIPs, because, the cost structures are such that, as you stay for a longer period of time, overall, your costs will be lower. Of course, given that your costs have come down dramatically, what makes the difference is, in terms of, the good performance that a fund can offer, which and also, of course, the best return that one could generate. That makes the significant impact and factor than the cost anymore. So stay invested for a longer period of time.
So we learned a lot about ULIPs as an instrument and newer aspects of this particular product. Thanks a lot, both of you, for sparing time and discussing ULIPs. Thanks a lot, Mr. Reddy. Thank you for being part of the session.
Thank you, Pallavi.
For more interesting and insightful sessions, keep watching economictimes.com.